All right, so the markets decided that yesterday's second rally, intraday rally, post Powell's comments, did not take as yields stayed where they were the whole time, and then equities came back down to where they were kind of post Powell's speech there. So an up and down, up and then back down day over the last day and a half of trading coming after Powell's speech. The market's trying to digest what's going on. You can see it appears it's leaning towards like starting to believe the Fed. These for some markets are the bonds market, futures market, to believe the Fed that they actually will continue to raise rates and that they won't cut rates anytime soon. And so you're starting to see the stock market starting to get a little skittish coming to that reality as well. So we're going to take a look at how the market's responded. How different asset classes are moving, how that's impacting this move, what some of the indicators are some of the signs of exhaustion we're seeing in different indicators on this current rally we're on, and then how likely we are again to start some kind of pullback to the downside over the next maybe week to week and a half. So I'm going to break all that down with you, what's driving this action today. And then we'll take a look at our trade idea of a stock that's a picture-perfect example of kind of the type of stocks that are kind of leading the way to the downside. And we'll talk about how to trade that. So let's go ahead and get started. Today is Wednesday, February the 8th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get started, I invite you to subscribe to our YouTube channel with this icon here, with the red subscribe button down below. Click the thumbs up icon to like our video, comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. And if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook Live video. Come down to the bottom, click this heart, it opens up this tab. Hit that like button. Same thing here, click the thumbs up icon. It takes you to this tab, hit that like button. Again, the more you do that, the more you like our videos, share and retweet and comment, the more they get pushed out to all of our followers on those platforms based on how their algorithms work. That's why we always ask for it. And thank you to those who do that. And those who don't, you can do that right now even while you're watching. Let's take a look at the S&P 500 with the market forecast indicator first. So last Thursday, we had this exhaustion type gap move, and then yesterday it was kind of an up down and then back up move. What was interesting about that last leg up yesterday was that it did not accompany a drop in yields like the first leg up did yesterday. So the yields dropped, stocks rallied after Powell's press conference started. Then towards the end of the Powell's press conference, yields rallied to their highs of the day, stocks dropped. And then as yields stayed at their highs of the day, stocks rallied back up again. So very odd move. As you can see today, pretty much nullified. So as yields have stayed near their highs. So you can see the market's getting very long in the tooth, near some of these important Fibonacci retracement areas. So it looks like we're at least going to fail on this attempt. Doesn't mean we won't ultimately get above those areas. But at least we're going to most likely going to fail on this attempt. The momentum line's back down, and twice it got to the oversold territory. The near-term line has not followed suit down there either time, and now is staying in the neutral zone. Momentum line's down a little bit, back into bearish territory. Market sentiment's falling. The intermediate line's still in the upper reversal zone, so we still have dark green shading and green line. We're still 3.5% above the 30-day moving average. We're still above these really important Fibonacci levels, 62 and 38. These are resistance levels that we broke above over here and then stayed above. These are trend-changing levels. See, these dotted lines suggest that we are above the 50% retracement of the correction and then above the 78% retracement of the last intermediate move, which would change the trend. So those are very significant in terms of changing the dynamic, the narrative to a bullish move. Remember, the Dow Jones already has done that. That's why it's way up here. It already got above these highs. It already got above the 50% retracement way back here of the correction back in November. It came back down and held it for support a few times before bouncing back up. And you can see it's now kind of sitting up above this 62% retracement of this rally. And you can see the intermediate line made another run. After ending its run, made another run here, and also appears to be ending, as you can see market sentiment's dropping way more, falling more. It's still a little bit higher, but it's got a faster decline than what you're seeing in the S&P 500. The NASDAQ has been really bullish here lately to the point of getting the cluster. Really getting that exhaustion move. Yesterday, you saw the big move up yesterday there, and then today's reversal. This is after getting above this 62% retracement. Again, the 50% retracement of the correction is right there, so we're still well below that. The 78% retracement of this current intermediate decline is right there, along with a few other lines sitting here too. So it's still underperforming the Dow, but again, you can start to see some signs of weakness showing up there. And then finally, your Russell 2000 again has been way more bearish than the others in the last week. As you can see, but it had been more bullish. Again, got the cluster, then it really went kind of parabolic there, and then now you can see the momentum line's down sharply. The near-term line's down in the bearish territory. We're still 4%, so it's not like we're just coming back from what was really strong levels. We were, 9% above the 30-day moving average there, which was one of the higher levels that we've had. Really about as high as we got in August. And then, like I said, with the cluster that preceded it, we were starting to pull back. That's all it is. We're just, we were really, really bullish, and now we're still bullish, just not as bullish there. As you can see over here, we only got about 6% above, which again was one of the higher levels, relatively speaking. Obviously, the green dot means it was in the top 10th percentile. And you remember too that SPY got the cluster that SPX didn't, so it's second cluster there. All right, now let's take a look at the weekly chart, and you can see. Give me 1 second here. Again, still, like we said on Monday, got the higher close still, though we have the lower high. So that's kind of the first weak initial stages of weakness. So very weak sign, not anything major. Obviously, it'd be a lot bigger sign of weakness if you got a lower close on the Hakineshi, which we have not so far. The week's not over. But you are getting a cross as of right now, a bullish crossover on the 10 and 40 week moving averages, but a bearish cross on the candles, right? On the Hakineshi candles, you can see down below their moving average there. So some weakness showing up. You can also see some weakness in the whole moving average as we're breaking below the moving average again there on the 200-day whole. We are getting some signs of weakness here. Again, you had the lower close. We closed below that body. Then we got a higher close, but we did not close above that body. So we're kind of right at it. So we're not really getting the bullish reversal, and definitely you got the parabolic SARs have flipped, and you still don't have the flip on and we are well past the 20 days now, so we still don't have the flip on the hull to a red. So we are definitely in that stage of where we're going to be heading lower. The McClellan oscillators turn negative, is not dipped below the minus 35, so positive and minus 35 anecdotally are the kind of the key levels to work with here on the New York Stock Exchange. We're not at that point, but still it's a pretty decent breakdown there. Obviously, the money flow has been relatively bearish. It did bounce back up yesterday and is still down, so we're getting progressively lower highs here on the money flow. Again, not necessarily the thing that we want to see from that perspective. Looking at the DMI, which has been so bullish, it still is. So you're still, you're obviously still nowhere near, even the beginnings of a bearish move. Same thing here. You got the intermediate trend strength. You're still above the green line. So, you're still bullish. You're just showing some signs of weakness, dropping below the moving average here on the 4-week range among all the other ones that I've shown you before. You can see the bands, the momentum is declining. The bands are still outside the Keltner channel, though we only did finish outside the Keltner channel the one time and then the exhaustion, and then we're back down easily below that and with falling momentum. So it appears, again, we're not in the upper quartile of the bandwidth anymore. We are, but we're not in the lowest. So again, we're not necessarily like painting a horribly bearish picture. You can just see that we're just not as strongly bullish anymore, as we're out below 60 already, and working our way back at below 100 and potentially back down below 20. So signs of weakness all across the board. The Arun indicator, again, no 4-week high point, so you still have, we're only a couple more days away. By Monday of next week, we'll be below 70 on the green line. So at that point, we're susceptible to any kind of breakdown going into Valentine's Day on Tuesday, where the CPI report's due out that morning. you can kind of see, we are set up for something. And, we won't get a new low point before then. This low point is going to move right over here. That's why the red line is moved up on the Arun indicator. And I don't think we're going to be touching that anytime soon, at least in the next couple of days. So I don't think we're going to get a spike to 100 on the red line yet, but also, we're also going to be easily below 70 on the green, and potentially working our way towards 50 on the green. And usually that just leads us to zero as we start a bearish move, and you can draw whatever line you want to draw, in terms of looking for some trend line support here, trying to draw the best trend line, best fit trend line possible. You get the idea of what the markets can do. Again, we're going to probably not have the greatest amount of volume. We did have average volume today, but we had a below average range. So when you put those two numbers in a context, 4.6 points is well below the average. And we're still haven't broken that 1.5% mark yet, and then the volume is below average too. You look at the volatility, however, and that made an interesting move here today. So let's take a look at that. So the VIX jumped up to 20, and you can see the big move higher, but you also see the correlation with the VVIX jumped up. The VVIX really jumped up today, big time. Jumped all the way up above 94. It's really, that's a big breakout move that we haven't seen in a long time from the VVIX. Again, this is setting the stage for him because they're very strongly correlated, and they've been negatively correlated, and they've been below 50% correlation for an extended period of time here. This is setting the stage for a rally in the VIX, right? The VIX usually follows the VVIX up to the upside, especially, again, in a seasonally bullish time of year for volatility. This is the time of year that volatility tends to ramp up. This is over the last 5 years, but obviously over the last 20 years, this is the time of year that we tend to get a decent rally in volatility. So we are definitely working our way up. You can see that even the 10-day correlation of the VIX with the S&P is now above the minus 50%, which is, again, it's rare to get positive. It's pretty rare just to get above 50%, negative 50%. Again, all these factors setting us up for a rise in volatility, which typically will coincide with some weakness in the equity markets. All right, now let's take a look at what's driving this price action. You can see, what's been up over the last 3 months. You got international equities with the Qs. You have real estate, bonds, and gold. It's like everything all thrown together. S&P, IWM lagging, and of course the dollar and commodities ended up lagging. Let's just take a look at how things moved here today. So let's go to February the 8th. All right, so you can see the S&P being down 1%. Q, this was a U.S. equity story to the downside. International equities were actually okay. Emerging markets way outperformed U.S. equities. Commodities were higher, though they were low early during the first stage of weakness, and then during the second stage of weakness, commodities actually rallied. And the dollar, you can see, was at its highest point, dropped, and then finished near its highest point of the day. So you can kind of get the picture of what's going on here from a macro perspective. The dollar has kind of ended its decline for now. It's been up and down last few days, but it appears to at least have ended its decline. It's above the 17-day moving average. The MACD is above its moving average. Long-term bonds have also ended their rally. So we are below the 17-day moving average now for multiple days, and we have, at least we're close to 3 red arrows, You can see the UUP has 3 green arrows, now has for 4 days, and then TLT has been flipping back and forth. At least it's had that first day of 3 reds. So, things are changing. We've been in this stage of weak dollar and bullish on bonds with yields dropping, but now yields are working their way up and trying to see what it's going to do here at 3.6% and see if they're going to make their way higher. And we talked about that inverted yield curve, and there was 2 ways that inverted yield curve could start to play itself out. Traditionally at very, very low levels, and has been below 50 basis points now for multiple months. Has been negative for quite a while here, for almost 9 months. So there needs to be a way for this to start to work itself out. Traditionally works out with Fed cuts, because then that's what brings the short-term yields down and leaves the 10-year yield drops too, just not as fast. But the problem is rate cut odds are dropping. As you can see back here, at 5% odds, we had about a 21% chance a month ago that we would be at 5% by the end of the year. Only 21%. We are now at about, what is that, 68% odds that we will be almost 70% odds that you'll be at 5%. And you can see we were at 4% odds at 5.25, and now we're at 33% odds of being at 5.25. So the odds have improved dramatically that we will not get rate cuts. And you can see by the month of May, you're looking at about a 77% chance of a rate hike up to 5.25. And you can see the odds of us being at 5.25 by the end of the year maintain are still really, really high. So, there's pretty decent chance that we will start to work our way up. In fact, there's a 31% chance that we'll get to 550. That's unlikely that we'll get there by June, but you're looking at a 37% chance by June that you're looking at 25, 25, 25. It's not very high. I mean, those are low odds, and it's never been that high. 5.5% you can see would be this green line. You can see it's only been above 40% barely for a period of time here, but this has been above 60%. The 5.25 now is easily above 60%. In fact, it looks like it's going to make its way to 100 and just stay there. So, in other words, we're going to be at 5.25%, whether it's next meeting or in May or in June. We're going to be at 5.25%. So the odds, we're starting to ramp up a little bit. The 2-year is kind of relatively flat, and you saw the 10-year is down a little off of its highs, but still up above 3.6%. This is a really important range for long-term bonds. Here, let me refresh this page. And then we'll get to that intraday so you can see the moves. You saw the original decline after the FOMC back here on the first, right? And you can see we since rallied those couple of days back up to 3.6%, and we're kind of stuck there. And then there's the move. This is that the press conference move from yesterday where yields declined and stocks rallied. Yields rallied and stocks dropped. Yields stayed high and stocks rallied again. So we're still near those levels. So we're still near those levels that we had before those comments from Chairman Powell. So I think the bond market and the futures market are starting to buy into this idea that the Fed will get these rates up high and keep them high. Remember, the goal is to get the real Fed funds rate up to the real Fed funds rate up to 2.5%. Because again, they don't want to be like what happened in the 70s where they stopped hiking rates, too early, right? Well, again, to get the rates if we raise rates to 5.25%, then the CPI has got to drop to 5.25% here, and let's go year over year. The CPI has got to drop to 5.25% over the next couple of meetings, right? You have two more meetings here before we get to the next rate hike, which will actually just get us to 5%. Well, right now the year-over-year rate's at 6.42. The next two meetings, we actually have a nowcast. For the next two meetings, you can see the odds of us, the odds of the year-over-year core is expected to be at 6.32. So we're still going to have 130 basis point. We're expected to have 130 basis point inversion by the time we get to the next rate hike, which again puts 5.25% on the table, and then you can see what ends up happening. So the Fed is trying to get the real Fed funds rate to at least be positive. Get the CPI down underneath the Fed funds rate, and then of course get it down so far under the Fed funds rate that we get this yield spread up to 2.5%. The issue is when you get up to 2.5%, which is generally where the Fed stops, that always induces recession. I mean, look at every single time here. It pretty much always induces recessions when the real Fed funds rate gets to 2.5%. It took years in the 90s for it to happen, and that's kind of, I think the Fed's trying to get back to this kind of yield curve environment where we have a positive real Fed funds rate for an extended period of time, and trying to get the Fed, at least the markets, to be more in tune with that instead of the last couple of decades or the last decade plus where the market's been attuned to the Fed keeping the real Fed funds rate below CPI, and trying to keep this negative, and then always promoting liquidity and markets moving higher. Remember, the Fed is also reducing their balance sheet here. We looked at this in our class today. We looked at the Fed's balance sheet reduction on a year-over-year basis. So 2018, one of our most volatile years we've had in a while, was really the first year that the Fed reduced its balance sheet over the course of an entire calendar year by 4%. They also reduced it by 8.25%, but keep in mind that 8.25%, that also included the fourth quarter of 2019 where they raised it by 6%. They actually raised the balance sheet by a huge number, about as big as the QE3 taper quarters, right? I mean, that's a huge number before COVID. And then obviously with the first quarter, when COVID was kind of starting, they raised it another 6%, and then of course the 56% jump when QE4 was announced. So big time jump in the balance sheet there. But you can see, here we go. We've had a couple of quarters now. Third quarter and fourth quarter 2022, they were both negative, not enough to offset these two positive quarters. So you ended up with a slightly positive. You ended up with a slightly positive, about 9% increase in the balance sheet in that year. But I expect 2023 will have a negative. Right? I mean, every week this year has been negative so far. In 2023, you can see going all the way into this year here. Let's do maximum. There we go. So all the way into this year, you can see we've been negative. We're going to have a negative year. Like the Fed's going, and the last time we had a negative year was, again, one of our most volatile years. We had two corrections in 2018, the first quarter and the second quarter, or fourth quarter. And the fourth quarter is a doozy. And, here we are. Have already had a correction so far. You can kind of technically say that this was the first quarter of 2018. And then now we may be headed towards more of a doozy, where we actually do get a move ultimately that gets us through the 200-week moving average and stays and keeps it there, right? You can see the weekly chart here, starting to show some. The weekly chart here starting to show some weakness. And the question now is whether or not, like here in August, where you broke out right above these highs, you broke out above a moving average as well, and then you dropped. Here we are again, breaking out last week above these highs, break out, but then failing, and potentially now getting back below these moving averages. That would be a failure on par with what we saw. And then this week right here would be next week, which is the CPI week, which again, if we get a print on the CPI that's 0.63, then you're going to have it's going to be, the markets are not expecting, in my opinion, a strong CPI number for this next week. And they might be starting to see that, and that's why you're starting to get some weakness. But if we get that big of a print, which is one of the bigger prints, we don't typically get 0.6% or higher in a typical year. So that's a big, big number. It's small compared to what we've seen in the past year plus, but normally that's a really big number. So that would lead, I think, in my opinion, to some more weakness, some more rate hike odds, and especially some more declines in the rate cut odds for the end of the year. Let's take a quick look at the sector rotation. So bear with me 1 second while I bring that up. And we'll just look at today alone. You can see the big weakness was in XLC, utilities declining, technology and consumer discretionary were underperforming. Everything else was down. Everything was below zero today. So big moves to the downside. Obviously XLC, here let's go to this graph here. Google was by far the biggest loser. Facebook as well. Down, you can see some of the energy stocks also showing some weakness. Let's take a look at Google's chart. That was the biggest reason why we had the declines. Again, I mean, it had all the signs of an exhaustion coming off of its earnings. And then yesterday's move, lots of fake out signs there too. And then, of course, seeing what we saw today, filling in the rest of that gap there, that's a big move down with a big amount of volume here. Meta is obviously showing some weakness as well. Big gap on its earnings. If we start to fill in that gap, it can really drop pretty sharply back down to that 200-day moving average. So you can see where some of this weakness lies. Apple and Amazon also showing some weakness. Let's take a look at Apple here. Apple you got multiple haramis. This is a harami pattern where you had a big bullish candle with an inside day. You had another relatively engulfing type pattern there. So relatively big size candle, and then another inside day on the bodies. As the MACD histogram has already peaked, you expect the MACD will peak. You're above the 200-day moving average. You have a gap to fill, which will be back below the 200 and the 17 for that matter. I mean, the gap between the 17 and the 30-day moving averages has really gotten pretty big, and obviously we are well above the 30-day. It's one of the bigger moves above the 30-day for Apple that we've seen for most of this year, and now we're starting to drop below it. So obviously there's some signs of weakness here on a lot of these major movers. I also showed you some weakness here in some of these energy names. Let's take a look at ExxonMobil. And CVX, you see how those two, CVX especially, continuing to show weakness there. So the energy market's not doing as well. The consumer sector is kind of getting beat up. Amazon especially. If you take a look at Amazon and Home Depot. Amazon, you can see, again, has filled in its gap, post-earnings gap, more than filled it in. And you're moving down there pretty sharply. And then, like I said, Home Depot also had a sharp move to the upside, kind of an exhaustion type move, and we filled in that gap. So you see what's going on in a lot of these companies, and it appears to be going to be working its way through most of these other companies as well, and we'll start to show some signs of weakness. Our trade idea of the day is on Illumina. Let's take a look at Illumina. You can see the big down day it's had post its earnings. Breaking below its 17 and 30-day moving averages, and the 50 for that matter, because it was converged on it, and the point of control. So MACD is dropping pretty sharply there. Here, let's actually look at the actual MACD. There we go. The MACD is dropping, and it's already still at pretty high levels. The histogram's already peaked. Now the MACD appears to be peaking. So we're looking at some, at the very best, convergence opportunities. Obviously, let's see, that's SPY. Sorry. Let's look at Illumina. There we go. You can see it's dropping down, close to getting below its moving average. Stochastics is out of bullish territory. So big time drop from that perspective. Looking at some of these other signs, you got the bearish crossover above 25. You see how low the ADX is. You are set up for some kind of move here. The ADX is really low. The Ichimoku cloud, if you take a look at the Ichimoku cloud, there we go. We are, very tight. We're below the cloud. We had a bullish trend going. It's gone. You have a negative rate of change there now. Looking at the Keltner channels and the Bollinger Bands, they're also suggesting, look how much the Bollinger Bandwidth has tightened. It's been tight for so long that the 150-day range of the bandwidth has really tightened up again. Last time it did that, we had a big spike. We had a spike out of that range, and that appears to be where we're set up again. You got the red dots. You never did get the green dots in this bullish move, which suggests that you might maybe end up getting the green dots in the bearish move, which means you potentially could get below. We are in the lowest quartile of the bandwidth. So, again, needless to say, this stock is headed towards some kind of directional move in one direction or the other. And you would expect, based off of what you're seeing on the charts, that direction would be to the downside. So what we decided to do on this trade was to buy, not the at-the-money put, but one strike out, and then sell down to the 190. That sets you up for a long put vertical spread. We position size for about half our normal position. So it ends up being 3 contracts going for about almost a 2-to-1 reward to risk ratio. Obviously, if we were to turn this thing around on Illumina, we most likely can keep our loss down to a much smaller number. If we were to get back above, say, 225, you're looking way up here. You're looking at about a $300 loss. Now you're looking easily above 2.5, maybe 3-to-1. So you got a good reward potential for a relatively high probability trade, considering the max gain is easily attainable inside of one standard deviation move. So for a directional trade, relatively higher probability. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free, like I mentioned earlier. Like us and follow us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.